G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Haron Christie-David, and I run a mortgage broking business called Entails Wealth, where we help property investors start out and scale up their property portfolios. And on that journey, we're really talking about trying to build confidence to make good quality property decisions. As part of that journey, I think one of the the secret weapons for a lot of investors has been using a mortgage broker. And it's no secret at the moment that probably most loans are written around 65-70% of all loans are written through a mortgage broker. So we want to kind of pull the hood back a little bit on the mortgage broking industry, which is probably a slightly different tack that we have on our podcast. Zoom out a bit and talk about what the mortgage broking industry is focused on, where it's headed to, and I guess some of the people behind the scenes that make the mortgage broking industry tick. And one of those people at the forefront of mortgage broking and driving at what we call an aggregator level is Mark Haron from Connective Broker Services. G'day, Mark. How you doing?
G'day, Aaron. Thank you.
Mate, a really long-time friend, someone that's highly respected in our industry as well. So I want to say thank you very much for jumping on and being here. Connective, I'll start with Connective and then I'll come to you in a second. As a borrower, Connective Broker Services probably wouldn't mean too much because it's a business-to-business type brand, so a relationship between a mortgage broker and then yourselves as an aggregator. So for the uninitiated, can you, in a nutshell, what's an aggregator and tell us a little bit more about Connective as well? Yeah,
so we're an aggregator of mortgages is, I guess, the industry terminology, and that's done through providing services to mortgage brokers. And we also manage the lender relationships. We have the agreements with all the banks. Yeah. And as hopefully most of your listeners know, mortgage brokers provide their services generally free to the borrowers. There can be some fees from time to time because the lenders pay mortgage brokers a commission. So we manage a lot of the commission management as well. Yeah. Compliance support, software services, all of those things are very much in the remit of what we do as an aggregator.
Yeah, great. And I guess underpinning that, you talk about software support, and as a broker, it's like, okay, who do I turn to for training, development, onboarding for team members, for example, trying to get accreditations with banks. So you're very much, yes, an intermediary for an intermediary as well. And that's probably why a lot of clients, sometimes they'll pick up what we call our credit guide or privacy document and say, okay, who's Connective and how does this affiliation work? And that's very much, so I guess if you've heard of Aussie or Mortgage Choice, they're what we call franchised aggregators. And that's probably why they're more widely known or popular in mainstream culture. But I guess for yourself, mate, the Mark Haron story, you've been in the broking industry for quite some time. I won't going to give away years, mate, but let's just say you've seen it grow from its infancy to where it is now in terms of maturity as well, which I think is fantastic. Professionalism has certainly gone up a notch as well. The rise of brokerages as opposed to single operators has certainly evolved as well. So a bit about your own personal journey and a bit about your industry journey as well.
Yeah, well, I actually became a mortgage broker initially and enjoyed it, and then just got roles in management. Helped another aggregator get established, ran that for many years, and then joined Connective with the business partners over there, and we grew that from its infancy from a couple of hundred brokers to now we have over 4,700 brokers that use Connective services. And so that's been a tremendous journey. And as you mentioned, there's been a lot of things we've had to deal with from a compliance perspective, royal commissions, and the introduction of more compliance activity on top of that. So I've seen the introduction of licensing for financial service providers. And then I've seen the more recent introduction of best interest duty specifically for mortgage brokers. Yeah.
So let's talk through that, because I think that's probably something that I won't say flies below the radar, but as a borrower, they don't realize that this is being done, because most mortgage brokers, majority of mortgage brokers play with a straight bat. So in terms of best interest duty, it pretty much was a framework that cemented our obligations, but it was pretty much what we were doing beforehand. It's just, I guess, formalize that. So
correct.
So someone that's unsure about what we call it BID, best interest duty, what does that entail, mate?
Well, it is acting in the customer's best interest. So it's putting your interest as the broker, as the business owner aside, and putting the customer's interests ahead of those interests. That's the fundamental background of it all. What it does mean, though, and how the industry is adopted, and again, with guidance from the Treasury and then through to ASIC, is we go through a process of a fact find and a needs analysis, breaking down, understanding what the client's requirements are, and then matching products as a solution to meet those requirements. So that sort of also helps with this whole, it's all about the best interest rate. It's not always about the best interest rate. Sometimes there's other products that will help you pay your loan off faster than the cheapest interest rate product.
Yeah, well said. And I think that's probably something that resonates for us in our team, which is someone thinks they're coming for the lowest rate. I'll give you an example. Someone came to me, this was a couple of years ago, what's the lowest interest rate? I said, Bank of China. Like, anyone else? I'm like, so it's really not about the lowest interest rate. Sometimes it's about a lender that you know of or you're comfortable to go with, or maybe has the best online banking, for example, or you get
that's pretty prevalent these days.
Cash back at the moment, for example, or faster turnaround times, or it's a specific type of bank policy. If you may be self-employed or you're a property investor, for example, or you're newly employed or you're contractor, like there's always background factors that come into play as a broker when we're doing lender selection or recommendations that aren't visible to a client as well.
Particularly at the moment with serviceability tightening up.
Yep.
Now, with interest rates going up, that impacts customers' repayment capacity because you're assessed at the current rates plus a buffer. And so that's having that impact there. Self-employed is another big one. Self-employed applicants, there's different lenders that will treat self-employed applicants much more favourably. And of course, you know all about that, Aaron, and that's what customers need to come to you.
I appreciate that.
Fantastic business.
I appreciate that, but I think one thing that we've done as a community inside Connective is gone, how do we learn from other great businesses and brokerages? Because I think we're always a student in the fact that we can always learn what other good businesses are doing, and a willingness to share amongst peers as well. I think that's something that I really enjoy about this industry, and we uphold as well.
Yeah, no, and look, you've been at the forefront of that, doing some events for us, and passing on some great advice to some of our brokers, and you've obviously been on the end receiving some of that great advice from brokers from time to time.
Absolutely.
And peer-to-peer learning is a really big thing in our industry, and certainly something from a Connective point of view that we think is very valuable.
Correct. I think we all want to see we want to see the industry succeed. So I don't really care if it's another broker in the same city. It's like, hey mate, there's plenty of opportunity out there.
Yep.
Mate, there's more than, I guess it's an abundance mindset as well. But I guess having a look through and seeing how brokers have evolved and looking at the current market as well, when you're talking and people may ask you, okay, so what are you doing? A barbecue question. But then you go, how do I choose a broker? What's kind of your non-negotiables or your list of things to look at when someone's looking for a mortgage broker? Yeah,
so the first thing, there's a couple of little basic things to tick off. First thing, they have to be licensed. So they should either be a credit representative or have their own ACL, Australian Credit License. So look for that.
Yep.
You can check that on the ASIC website as well.
Yeah.
The other thing too, they must have an AFCA membership. That's a complaints membership process, and that should be documented, and you should be able to find that and see that as well. Otherwise, you may not be dealing with a real fair dinkum broker. They might call themselves a broker, but if they don't have those things, they're not there. Yeah. Industry body membership is great. The MFAA or the FBAA, that means that they're being held to a higher and a professional standard as well. So those attributes are great. The next one is probably to try and understand that broker, and a lot of it you can only do sometimes personally when you're in conversation with them. But are they suited to the type of lending you are doing? If you're a first home buyer, there's some brokers that are really experts at that. If you're an investor, there's some brokers that are experts at that. If you've got someone like Entails Wealth, they're experts at everything, so which is always very good. But make sure you look for like. Most brokers' business comes from personal recommendations.
Yeah.
It comes from existing customers referring, and that's a big part of what how brokers attract. And I think it's also fantastic in terms of we've gone in this industry from when I started was not even 20% of home loans were done by brokers. We're now up into the 70% range, and I think that's attributable to the fact that brokers provide a great service and customers keep coming back and they keep on sending their friends to brokers.
Yeah, I think it's something you spot on there is around the personal touch. Like I think people will want to have that one-to-one relationship, for example, with their broker. It's almost a pride that's like my broker, for example. It's also a responsibility that you have as a broker to go, you got to maintain those relationships, because if you don't, then they'll effectively vote with their own feet as well, which keeps us highly accountable as well.
Absolutely.
One thing that I think that we skirt around the edges, and I just wanted to kind of cut through it, is broker commissions. And I like to think that we're pretty transparent with it in our business. I don't think there's anything to hide. We are paid by a lender for placing that loan with that particular bank as constitutes of a upfront payment and an ongoing, what we call a trail payment as well. And I guess occasionally a client will go, hey, take me through like your commission structure. I'm generally saying, look, pretty much there's parity between lenders in what they'll pay. Now, some lenders might pay a little bit more because they're tougher applications. Maybe it's a niche self-employed deal, takes a lot more legwork, or it's a lot more specialized. And some banks pay just a little bit less than that because maybe they're a smaller lender as well. So, I mean, you probably know every rate of commission by banks just because you've been around for a little while, right? But how do we convey a sense of confidence to a client to go, there's no way that we could possibly be incentivized by commission over policy or over a loan strategy?
Yeah, correct. And again, that's best interest duty.
Yeah.
So if the broker is putting a client into a lender and a product because it has the highest commission, they're not acting in the customer's best interest. Now, it could be just circumstantial that is the case.
Yeah.
And, I suggest to brokers that they should explain that a bit better. There is a disclosure requirement. I believe it's a top 7 lenders panel that's sort of built into some of the best interest duty compliance documentation. So there's a way to sense check that from a customer's perspective. The other aspect too, you can show that you use a broad base of lenders.
Yeah.
It's not all just going to the same lenders, but so that's sort of the main areas, is just understand that there is a disclosure requirement. And if you do, as a customer, see that, wow, this is right on the upper spectrum, just, if you want to, just sense check that and say, why are we going to this lender? Am I going to get charged a higher rate? More times than not, it's not the case. As you pointed out, Aaron, it's because it's a more complex loan and some of those lenders pay more. So the commission is the lender saying, well, hey, after you've given the advice to the customer, been through that, next, we're working for the lender. We're doing all of this work that the lender would normally have to employ staff to do. So that's where that's why they justify, well, happy to pay the commissions, because it's 90% of the job is done.
Yep. And then the ongoing trail?
The ongoing trail, well, bit of a story here, but the trail, initially, brokers only got paid upfront only.
Yeah.
And then many, many years ago, a few of the lenders turned around and said, well, look, the cost impost of the larger upfront is a bit big. We're going to cut that in half, and we're going to pay the other half over the period of the loan. And it's going to be paid based on the balance of the loan, and it's going to be calculated this way. Of course, that puts that at risk. If it goes into arrears or the loans get pre-financed, then that commission is lost to the broker. So again, it really puts an emphasis on a broker to put the customer in the right product that and make sure they can afford it. And then continue to keep in contact with that customer to ensure that, or be available to that customer to ensure that if the customer wants any further services, it's there. Now, some might say, well, is there an incentive for a broker, just to keep a customer at that bank?
Yeah.
Not really, because the trail commission is significantly smaller than the upfront commission.
Yep.
And so brokers are more than happy to refinance a client, take them to another lender if that product is better, more appropriate, and then that's what a lot of brokers will do.
Awesome.
But I'm seeing at the moment, and it's been very good, the banks have reacted well to this. There's a lot more repricing going on, and the banks are trying harder also to retain those customers, so they're offering better incentives and better rates to stay at some of the existing banks. So that's why that conversation with the broker is so important, because refinancing isn't necessarily the only solution. And again, getting back to affordability, with the interest rates having gone up, the bank might say you can't afford the loan you're in sometimes.
Correct. And I think that's, it's skin in the game for both the broker but also the lender as well, because some clients actually want to stay where they are. They've got internet banking, they've got the credit card set up, the app's already on their phone. It's like, hang on, the pain to switch doesn't justify sometimes the savings or the headaches of paperwork, which is cool with. I've got no problems with that as well. But you just want to put your lender on notice to go, hey, don't take our business for granted, or don't take our loan for granted as well. Perfect. One of the beauties, I guess, of what we call at an aggregator level is that you get to see across the board a lot of data, data on data, I'm sure as well. So when you've kind of popped the hood on what's going on at the moment, and probably the last couple of years have been bananas, right, in terms of purchase. I've got a gut feel what's going on in my business. Speak to some of my colleagues. I'm like, we've got a gut feel on, a couple of things. One is obviously refinancing is rife at the moment. Pre-approval pipelines, I'd say, bursting at the seams as well. And then you look at some mortgage prisoners as well, and also the data kind of points to where where some states are more purchase heavy and other states are more refinance heavy as well. So kind of a couple of questions in there. It's kind of what are you seeing from the data and what's the story telling you at the moment?
Yeah, well, as we said, we have a lot of data. Like of those 70% mortgage broker loans, Connective brokers do 22% of that 70%. So it's a significant number. It's about 1 in 7 home loans that are done in Australia.
Yeah, okay.
And what we are definitely seeing is applications have come off year on year a little bit, but not as much as what we thought they may have with the impact of interest rate increases. To your point, there's a lot of pre-approvals in that as people are sort of gearing up, wanting to understand where they are, particularly investors wanting to see where the property market goes and being ready to pounce when they see an opportunity. Conversions, which is where application goes through to settlement, that has come off again. That's a lot of pre-approvals coming through. But one of the big data points and part of that driving some of that is refinances. That has increased 25% year on year. Wow. So again, customers looking to reprice and get cheaper rates in some cases. Sometimes they're doing it for the cashback as well. So there's a lot of that activity coming through, and I believe that the market, in terms of the home loan market, it will still be very strong because of that opportunity for brokers in the refinance and the repricing, but it will not be at the peaks that it was last year and the year before from that perspective. But, it won't be down. It won't be down significantly. It'll just be down a bit as we see probably the next 1 or 2 Reserve Bank rate rises come through. I did see the governor. He's been jawboning around a few things, trying to get people to stop spending money is one, but he did make a comment that, sooner rather than later, they're going to have to pause, make sure that they're sense checking all the data before they drive, too many people to the wall in terms of their mortgage repayments. Yeah,
I mean, certainly cash flow. I've just done a recent episode talking about fixed rates and fixed rate. Obviously, we called it the fixed rate cliff. It kind of gets bandied around as well. I mean, we were at a conference a while ago, and lenders did kind of cite that as probably an area.
Well, there's one lender, major lender, they got $80 billion worth of home loans coming off 2-year fixed rate in the next 3 to 12 months.
Yeah, great. Yeah. I've just done a chart pack on that, so I'll give you a heads up when that chart pack's public as well. Right. But so I mean, what do they do from a resource perspective? Because they can't physically contact that many clients to go, well, how do we reprice you? How do we reservice you as well? So what happens to
Well, they are very reliant on the brokers, again, providing that service.
Yeah.
A lot of them have set up systems and tools now, repricing calculators and tools, which brokers are using. 1 or 2 have got them set up directly for a customer. I don't know, with one particular bank, you can go into it with the broker. He can load up the information, and it's just reassessing a few little things, particularly your loan to value ratio.
Yeah.
Because the lower the loan to value ratio, the cheaper the money is for the banks. They get to hold less capital to have to fund those loans, so that they're cheaper, more efficient. But once you go through this repricing tool with this bank, you accept the new rate and it's automatically changed within 24 hours.
How good's that?
So there's a lot of these. The banks were really encouraging the banks, and that's again another thing Aggregator does, is we have a lot of these conversations with the banks and saying, what are you doing about this? Look at the pain points here for the customers, the brokers. How do we alleviate that? And getting very systemised respect.
Yeah, spot on. You mentioned about pre-approvals and also the investors that are ready to kind of pounce. And one probably area, I can only speak at a granular level in our business and maybe some colleagues as well, but the prevalence or the increased appetite for commercial as well. You're probably seeing that in aggregated data as well, which is the number of applications going through to buy commercial properties. I guess maybe people have got a couple of residential properties now looking to expand based on confidence, or higher deposits required for some commercial properties. And also some banks are putting out some pretty good product as well on commercial products. Probably what are you seeing? We call it diversified. I just think it's a natural progression as well from a growing business. But how's that playing out from the data?
Commercial business has increased sort of from 22 to 21 was about 100%. Sorry, about 80%. 21 was about 100% uplift in commercial activity we saw. And it is a lot of that. It's investors, self-employed people saying, look, I might as well buy my own premises rather than renting. When the business gets to that level, it's a great position to be in.
Yeah.
Because apart from usually wages, rent is one of your next biggest expenses.
Yeah.
So controlling that, managing that is also a really, really relevant thing. So yeah, we have seen a lot more interest in commercial. I think what we saw through the pandemic also was that a lot of the suburban areas really started to be a lot more attractive because it had all the traffic going through there. You could still go out and get your bread and your coffee. You just weren't going into the city, into the office as much. And so I think it's seen a bit of a resurgence into some of those markets.
Like the neighbourhood has kind of put itself back on the map, which is local services. You don't have to go into the city, you and I probably aren't getting our hair done as much anymore, but maybe for like the local cafe, you weren't commuting into the city 5 days, so you're spending it locally at a cafe, for example. Your dry cleaning's done locally as well, as small examples. And then those smaller businesses now thriving, putting down roots. Like you're saying, that's very much a similar story, which is in my area, I don't want to move. I want to own the premises as well because I'm paying rent, and like any person renting, at some point you go, well, I grow or go, and I want to stay here and grow and expand my business, but I can't do that when I don't have that security.
We're starting with a lot of corporate businesses, and ourselves, we've got 200 staff around the country, but predominantly Melbourne and Sydney, and we do have them coming into the office at least on doing face-to-face business at least 3 days a week. But they're still spending a considerable amount of time still at home, still in the local suburbs. So, it's quite encouraging. So that's not going to go away. The way we work has, I think, changed for the significant future. Yeah, definitely that evolution's there as well. So I guess the other one is a runoff rate or a churn rate as well. So this, again, sounds like a very banky word, but it just means when loans kind of come off and they either refinance or they get closed off. So that runoff churn rate, what does that look like at the moment? It's still quite low. And just on churn, the way I create the definition of churn, that's when you refinance, or a client refinances, or your broker refinances a client where there has been no benefit to the customer. So refinancing activity has definitely increased but when you look at some of those portfolios, it's staying within the business. And sometimes it's might be changing banks, but from our perspective, it's still there. From a broker's perspective, in the majority of cases when they're doing the refinance, it's still there. There's a lot more customers coming to the brokers now, though, to first time and saying, can you look at this and can you refinance me or get me a better rate, which is great. The one thing we try and keep a very strong eye on is the arrears rate. And interestingly, at this point in time, it is still very, very low. And it's been very low for a long time because we had low interest rates. But even with the current increases, it's still quite low. Now, we probably won't see any real effects into that arrears because they're not normally reported until they're about 60 to 90 days in arrears. So we might see that data shift a little bit more, and that's probably what the RBA will be looking at too. It's not just inflation, but what's happening with those arrears. One comment I was going to make before too was one of the big things we're seeing is in our data is that average loan sizes has reduced. Now, some of this might be repayment capacity, but I think even when people are refinancing, they're refinancing just their outstanding debt, and quite often a lot of people have had big buffers in there. They've been able to make extra repayments. They've had a lot of money sitting on offset, but they're saying, well, if I have a smaller debt that I'm refinancing to, it means it's going to keep my repayments down significantly as well. And that's one of the strategies that brokers will talk to you about employing if keeping your repayments down is significant. Also, changing the term of the loan. If it's got 15 years to run, but you put it out over 20 years, that's also going to help keep the repayments down as well. Well said. Well said. Hey, mate, thanks very much. I don't say you're a busy person. I say you're juggling a lot on your plate, mate. So I certainly appreciate your time and energy to be here, and very grateful for sharing your knowledge and your wisdom with us, mate. For our listeners out there, like I mentioned, I know this is not your typical buyer's agent interview, but I think it's very, very important that you get an idea about, from a mortgage broker's perspective, if you're looking at using a broker, that you understand what the intricacies of the industry are about, and also how to choose the right mortgage broker that aligns with you and your strategy as well. So, Mark, thank you very much, mate. Really, really appreciate your time, and look forward to catching up with you soon. Thanks, Aaron. Happy to support yourself and Bernie and the Atelier Wealth team. I really appreciate it. Thank you so much. No trouble. Wonderful. That's a wrap for another episode of the Australian Property Investment Podcast. If you've got any questions, please feel free to reach out to us. Even better if you leave us a review, and that way we can grow, expand, and bring on more great guests onto our show as well. Thanks very much.